Let's ask Solus Alternative Asset Management Chief Strategist Dan Greenhaus back with me at Post 9. It's good to see you. So much for seasonality. I thought that was on our side.
Yeah, no, we are off the lows of the mid-October level. Obviously, the December has not worked out the way December typically does, but seasonality is more than a month or a week. It's the fall through the subsequent winter, and so obviously there's still January and February, let's say, for seasonality to work or not.
You still think it can?
Yeah, I mean, again, we talked about this the last time I was on. You do have a couple of tailwinds here. Obviously, December performance has not been great, but you do have a couple of tailwinds here that might carry over into the new year, with the caveat that like things are every bit as uncertain in the first quarter as they are here in the fourth quarter. But yeah, again, seasonality goes through January and February, so the seasonal trade, if you will, can still work.
Yeah, I think the pushback on that is that, you know, the central banks around the world don't care what the temperature is outside.
No, that's right.
Or what time of year it is. And to people like David Tepper, that supersedes everything. That the wall of tightening, if you want to call it that, the wave, really, across the globe is too substantial a wall for us to scale.
And I would agree with that. To be clear, the seasonality trade is about positioning and flows more than any fundamental or economic inputs. So obviously not obviously, but they're two separate things. But to the point about central bank liquidity and rate hikes, I mean, that's the overriding theme that persists into the new year. The degree to which central banks around the world, not just the Federal Reserve, but all central banks more or less, have drained liquidity and tightened policy, that increase in global short rates is a terrific leading indicator for economic and market performance looking out, call it 6 or 12 months.
Is it still underappreciated? I think that's the key part of this story. The bulls have come on through this period and suggested, well, they're slowing the pace. That's bullish. They're not going to be able to raise rates as high as they can because the economy's slowing, and they're not going to have to because inflation's coming down. The other side of that is you're getting it totally wrong. The risk is to the upside on the ultimate terminal rate, and inflation might be stickier than people think, and central banks around the world are tightening at a brisk pace, and they're going to go higher than we think.
Yeah, and the discrepancy between those two positions, both entirely valid, speaks to the level of uncertainty that we're dealing with in markets here. I mean, you've got several prominent economists making the case that inflation is coming down, not just goods, but on the services side of things as well. And that's going to give the Fed a tailwind, so to speak, to stop raising rates and potentially even cut them towards the back half of next year, not because the economy is worsening, per se, but rather because just simply from the inflation side of things. And then on the other hand, you've got fairly prominent economists that do this work, that are assessing the landscape, that are looking at it from an incredibly dire position that says, hey, you can't raise rates 500 basis points in 12 months and not have pretty severe economic repercussions. I would argue I'm somewhere in the middle, which is, I guess, a safe place to land, but you do have pretty prominent and accomplished people in both sides of those arguments.
What's a more interesting tell on kind of where we are and maybe where we're going? The fact that mega cap tech was as bad as it is and the market isn't worse,
yeah.
Or merely the fact that mega cap tech is bad and if it doesn't recover, maybe the market can't really get any footing either.
Well, I mean, listen, I think, to be clear, I talked about this with the producers. Like, if you had told me to start the year that all the tech stocks, NVIDIA, Facebook, Microsoft on down, would be down 40, 50, 60% year to date, there's no way I would have told you the S&P would be down 20%. I think everybody would have agreed it'd be down considerably more. The fact that it's not speaks to the strength that we've seen, particularly in energy, but also in healthcare. But more generally, can the market rally without tech? I would argue that it can, and I'm reminded of I want to say it was 2013 when people were referring to the market. I think it was 2013 when people were referring to the stock market as the NBA market, the nothing but Apple market. And then Apple collapsed and the market continued going up. I think the reason why passive investing for large cap equity usually works out is because the puts and takes in markets, it's very difficult to time when Apple's going to go up and Apple's going to come down and the rest of the market's going to go down and then come up. And a broad index of 500 stocks is usually going to compensate for those losses. So the short answer to your question is, yes, I think the market can keep going up, can start going up, even if tech doesn't.